Buddy, welcome to today's fundamentals. Hello, Peter. How have the markets been behaving?
Let's make a start with yesterday. We had noted the slowdown of the UK CPI rates. We have to note here that the release had a strong bearish effect on the pound, which dropped especially against the US dollar. After that, we had a number of US releases. The first was the US retail sales for January. Now, the retail sales growth rate accelerated beyond expectations, and it reached around 3% month on month, which in combination with, say, for example, the improvement of the New York Fed Business Index, Manufacturing Index, and the slight improvement of the industrial production growth rate, all of that tended to push the US dollar higher. More or less, I would note that it seems as if the worries for a possible recession in the US economy have eased. And if we see the strong retail sales growth rate in combination with the elevated inflation data, which were released on Tuesday, that could be also keeping the Fed on a very hawkish path. Definitely more rate hikes are to come, and most probably the Fed will be maintaining high interest rates for a prolonged period of time. I would also be noting during today's Asian session the release of Australia's employment data. We had an employment change figure which improved yet remained in the negatives. That was below market expectations substantially, while the unemployment rate jumped from 3.5 to 3.7%. Overall, the release as such tended to disappoint Aussie traders. It was characteristic that at the moment of the release, the Aussie against the US dollar dropped at around 36 pips. And it was a blow practically for AUD. I would note that the easing of Australia's employment market tightness more or less may cause RBA to have second thoughts about future interest rate hikes.
And how about the US stock markets?
US stock markets were in the greens. More or less, traders were encouraged by the strong retail sales and the easing of the recession worries in the US economy. I would turn my attention towards European stock markets today, actually. We have a number of earnings reports which are of interest. I would be highlighting Commerzbank. I would be highlighting Airbus and Renault, the automaker. It's interesting, these three are interesting in the sense that, especially about Airbus, we will be keeping a close eye over the expected number of aircraft to be delivered during the year. Commerzbank is about to signal, if not announce, that it's going to be giving a dividend, and that would be the first, if I'm correct, since 2018. Similarly, Renault is expected to have a big injection of profits from Nissan, the alliance it has with the Japanese automaker, which could push its profitability considerably higher. Other than that, it's all up to the market mood. Should there be a more optimistic sentiment, we may see US as well as European stock markets rising.
And how about the gold prices?
Gold prices dropped. The negative correlation of gold with the US dollar was on display once again. I would note, though, that also the rise of US yields over the past 10 days or so is not helping. Actually, it's weakening gold's price as well, given that a rise of US yields would provide a lucrative alternative for investors towards US bonds. And that may be easing the demand on the precious metal.
And what about oil prices?
Oil prices edged higher, and we have to note here that oil prices edged higher, especially WTI, despite a substantial surprise buildup of US oil inventories being reported by EIA. It was characteristic that EIA showed a rise of oil inventories of around 16 million barrels. I would note that the market shrugged the release off and practically seems to be focusing more on the demand side of the commodity. There are high hopes about China's reopening boosting the demand of oil, and I think that was the main factor behind the rise of oil prices.
And what's on the calendar for today?
But we have a rather empty European session. I would be noting, though, Turkey's FX reserves, which could be of interest for tier-wide traders. We have a packed American session. And I would make a start with the construction data from the US. Now we're getting some mixed signals here. On the one hand, the building permits growth rate is expected to drop while the house starts number is expected to rise. I would also be noting the weekly initial jobless claims figure is expected to rise and reach 200K. Should that be the case, we may see the US dollar slipping. And I would be also noting, or if you prefer highlighting, I think the main releases for the day would be the Philly Fed Business Index, which is for February and is expected to improve. Should that be the case, we may see the USD getting some support. And the second release would be the PPI rates of the US. And given that we had already the release on Tuesday of the CPI rates, the PPI rates for January come into focus. They are expected to get out of the negatives and accelerate on a month-to-month basis. And I would say that should that be the case, that would imply that the quality of the inflationary pressures is still strong and could provide some support for the USD.
And what's up on the monetary front?
We have a high number of speakers. I would make a start from the US with Cleveland Fed President Mester. I would also be noting St. Louis Fed President Bullard and Fed Board Governor Cook. I would expect more or less the comments to be more inclined towards the hawkish side. And should that be the case, we may see the USD getting some support. I would be highlighting definitely from BOC the Governor Tiff McClellan. Most probably he will be also making some hawkish comments. On the other hand, we get from UK BOE Chief Economist Hugh Pell. He may be easing the hawkish tone somewhat, given that the bank more or less has downshifted its hawkishness over the coming months and its forward guidance, and that could be weakening or at least easing the support on the pound. Now, during tomorrow's Asian session, we have from Australia RBA Governor Philip Lowe. He will be speaking before the Australian House of Representatives. It would be the second appearance before Australian lawmakers. Note that in his appearance before the Senate, RBA Governor Lowe had received strong criticism about the consecutive rate hikes of RBA. And RBA Governor practically maintained his hawkish tone. And I would expect him to do the same tomorrow as well. Such a development could provide some support for the Aussie. Other than that, I would note also that Cleveland Fed President Mester is also expected to speak for a second time.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
Welcome, everybody. My name is Peter Iosif, Senior Market Analyst at IronFX. We're going to be going through the technical part of the presentation for today. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame, the 4-hour time frame, unless otherwise stated. Now, with no time to waste, we note that there was a strong upward movement which tested beautifully the 103.75 resistance line, even at some point surpassed it, but quickly was driven below it once again. So overall, the sideways motion at the highs of, I would say at the 1 month highs, seems to remain. To the downside, we note the 102.45 as the low boundary of the current sideways motion of the US dollar index, and tend to maintain this as long as these two levels are being respected. Now the RSI indicator is slightly above the reading of 50. It's currently at, give me a sec, 56.5. Not much, but still there is some residue of bullish sentiment left. Should the bulls be able to regain control over the index, I would expect it to clearly break the 103.75. Actually, I would require for bullish outlook such a break. And we may see it aiming for the 105.40, a level which provided the resistance back here. On the other hand, should the bears take over, we may see the price action dropping, breaking the 102.45 support line, and start aiming for the 100.70 support level. The 102.45, note how it provided support here, resistance here, while the 100.70 was the level at which an intense downward motion of the index had hit the floor and bounced back up, and that was around the early days of the month. Let's have a look also at EURUSD. Readjusting the chart. Okay. So EURUSD has maintained its sideways motion despite an initial drop which aimed for the 1.0655 support line. Didn't quite reach it. Also note how the Bollinger Bands remain in a sideways motion, practically flat. The RSI indicator is just below the reading of 50. It's actually at 47. So we tend to maintain a bias for the sideways motion to continue between the 1.0790 and the 1.0655. Now, should the bears take over, the first possible stop definitely is this one. The next one, though, could be as low as a 1.05, a level which provides support here. On the flip side, should the bulls be in charge, we may see the price action of EURUSD being on the rise. For bullish outlook, we would require a higher peak than this one and this one, so the R1 will have to be clearly broken. Hence, the price action in this case would be practically paving the way for the R2 1.0925, a resistance level which provides resistance here and here. Moving now to GBP/USD. Readjusting the chart. GBP/USD breaking, dropping, breaking the upward trend line which we had drawn. And I think that's the most characteristic element which forces us to switch any bullish outlook in favor of a sideways movement bias, given also that the price action proved unable to even test the 1.1970, which is the boundary, the low boundary of the current sideways movement. Here's the upper one. So we maintain the bias for the sideways motion to continue between the S1 1.1970 sorry, 1.1970, and the O1, 1.2215. Should the bulls take charge, I would expect the price action to rise, break the R1 which provided resistance here, and at the end here, and start aiming for the 1.2345, a level which practically was the upper boundary of the past sideways motion. You can see that it had multiple tests, 1, 2, 3, aimed for here, 4. While on the flip side, should the bears take over, we may see the price action dropping, breaking the 1.1970 support line, and start aiming for the 1.1840. 1.1840, there's 2, a level which provided beautifully support here. Note how it has stopped the intense downward motion around the early days of January. Interesting note, the RSI indicator, which is below the reading of 50 but is rising. And that tends to exactly imply that the influence of the bears over the past direction is slowly fading away. Okay, let's have a look at USD-JPY. USD-JPY, which continued to rise, and now the interesting element is this one. Let's readjust the chart. Repositioning a little bit the labels. I would like to see how the market reacted on USD-JPY upon the release of the US retail sales. So allow me to drill down to the minute chart. Unlocking the chart, widening it, rolling back to the time of the release yesterday. It is. Who was this one? Note how the pair jumped around 36 pips upon release. And note how it affected a bullish trend in the minute chart that was kept practically over the next 1-2 hours. It was very, very interesting. There were a number of traders which may have been riding this wave here. Back to the forward chart. Now it's clear that the bullish movement seems to be maintained, but the upward trend line is coming under threat. So as long as the upward trend line remains intact, we maintain a bullish outlook for the pair. On the other hand, should the pair stabilize and break the upward trend line, that would be the first signal for change from a bullish outlook towards a bias to a sideways motion. Should the bulls maintain control, I would expect the price action to bounce on the upward trend line, maybe even shift it a little bit to the right, but overall rise, break the 134.75 resistance line, and start aiming for the 137.80. That was a level which provided resistance back here and here, so and support here. So it's a pretty valid level, and here. On the flip side, should the bears take over, I would expect the price action to drop, definitely break the upward trend line. However, for bearish outlook, we would require also breaking of the 132.85, a level which provided resistance once, twice, 3, times and support here. So it's a pretty valid level, and should that be broken, I think that's going to be signaling the start of a bearish trend. In which case, practically the gates would be open for the 130.40 support level, a level which provides support here and here, as well as resistance numerous times, and support here. A sideways motion could occur should the price action break the upward trend line, but remain within the range between the R1 134.75 and the 132.85. That would be something like a movement between the levels. Let's have a look at USD CHF. Nothing much here. The sideways motion of the past month practically is being maintained, clearly actually. It's interesting how the pair is moving in a sideways channel. So we tend to maintain our bias for a sideways motion to continue between the 0.9275 and the 0.9145. Mind you that traders try to start selling once it reaches the peak, as the downward motion is expected then, while start buying once it nears the low parts. Should the bulls take over, we may see the price action rising. We would require clear breaking of the R1, the upper boundary of the current sideways motion. And should the 0.927175, the R1, be broken, then practically the way is paved for the R2 0.9405, a level which was tested back here. On the other hand, should the bears take over, I would expect the price action to drop. Definitely would require lower trough than this one, so the 0.9145 support line, the S1, would have to be broken. Without breaking this one, we have no bearish outlook. And that would imply that practically the gates for the 0.9025 have been opened. Moving now to the Aussie. The Aussie, which seems also to remain in a sideways motion. I would be noting though that we had the release of Australia's employment data today. We discussed that earlier during the fundamentals. Let's have a look at the market reaction at the moment of the release. Unlocking the chart, drilling in to the 1 minute chart. Definitely work back here. Give me a sec. It was at 4. Here we are. and we can see the intense downward motion. However, that's far earlier. That's why we couldn't find it. Sorry about that. My bad. Here you are. And we note how the pair dropped. See, it was massive. It was around 36 pips. So we had a substantial market reaction. The Aussie practically suffered a hit here. And it was understandable in the sense that the data was far worse than what was expected. The unemployment rate was expected to remain unchanged at 3.5%. It didn't, it rose to 3.7. But we have to note here that the market within 1.5 hours practically regained its confidence and rose back up to the levels it was before. So it was a shocker, however, it didn't last long. Let's go back to the 4-hour chart, readjusting, locking in and readjusting the chart. We tend to maintain a bias for the sideways motion to continue, most probably between the 0.6880 support line and the 0.7010 resistance line, between here and here. Note that the RSI indicator was pretty low. It was nearing the reading of 50, however, has been on the rise, and that allowed it to reach pretty close to the reading of 50. It's actually right now at 47.3, also implying a rather indecisive market, and definitely that the influence of the bears for AUD/USD is fading away. Should the bears though take over, I would expect the price action to reverse direction, break the 0.6880 support line, and start aiming for 0.6740, a level which provided support beautifully here. On the other hand, should the bulls take over, I would expect the upward movement, which was initiated practically in the American session yesterday, late American session yesterday, to be maintained, intensified even, breaking the R1 0.7010 and start moving towards the 0.7130, a level which provided resistance here. Let's move to USD CAD. Readjusting the chart. Also in a sideways motion, pretty long one. And that's been kept since the 6th of January. Let's once again draw the boundaries. Maybe with a break to the upside here and a break to the downside here. Overall, the main body of the price action remains between the two mentioned levels. So we tend to maintain our bias for the sideways motion to continue between the R1 1.3470 and the 1.3285. Before we move to the bulls, it's interesting to note how the RSI indicator is just running along the reading of 50. And that's also implying exactly a rather indecisive market, which could provide more support in the sense, I wouldn't say support, could solidify the sideways movement of the pair. Also note the narrowing of the Bollinger Bands and how the 50 and the 100 moving average exactly have flattened out and are so close to each other. Should the bulls take over, we may see the price action rising. We would require a clear break of the R1 1.3470 and the price action to start aiming for the 1.37. On the flip side, should the bears take over, we may see the price action of USD CAD dropping breaking the 1.3285 and start aiming for the 1.3095. Let's have also a look at the Kiwi. We haven't checked out that pair for in the DUSD for a long period right now. Okay, it's in sideways motion, but it has stepped down. You can see that this level has now been turned into a resistance line. So let's correct that. Let's color this in green. 0.6060. Readjusting the chart. Let's correct the labels. Starting with the R3, which is now being placed at 0.6575. The R2 at 0.6465. The R1 at 0.6360. The S1 at 0.6270. The S2 at 0.6190. And the S3 at 0.6060. Locking everything in. So we tend to maintain a bias for the sideways motion to continue. It's interesting how the S1 0.6270, despite being extensively tested, in our opinion, held its ground. And on the other hand, to the upside, we note the 0.6360 as another level to watch out for as the upper boundary. So we would expect, given also that the RSI indicator is nearing the reading of 50, it's actually at 45.6, and that could imply that the movement of the pair is to remain between the pre-mentioned levels. Should the bulls take over, we may see the price action rising, breaking the 0.6360 and start aiming for 0.6465. On the other hand, note how the 100 moving average is about to cross to the downside the 200 moving average. The 100 moving average is the green line, and the orange line is the 200. However, we could switch that, and I would be taking the 50 and the 100. So practically note how the bearish cross practically signaled the downward movement of the pair. Should the bears take over, which for the time being does not seem to be the case, but note how the 50 moving average is moving lower, as does the 100, as does recently also the 20. In which case we may see the price action dropping. I would require a lower true than this one, and that would allow us, that would force actually the pair to drop below the 0.6270 support line, and would allow us to start drawing a downward trend line which would show us the limitations of the bearish movement. Next possible stop for the bears would be the 0.6190. Let's have a look at gold. Gold, which is lower, but seems to have stabilized just above the 1824, and that would imply practically a sideways motion, in our opinion. However, I would also like to readjust the levels here. The downward motion and its drop. Note how it verified the support line here. It's the same level, and it's the 1830. Yep. 1830. I would like also to readjust the support line, the S2, moving it higher to these levels. One touch, second touch, and that would be the 1785. Let's have a look also at the S3, where it rests. There's a nice show here, how it could edge a little bit higher, like this, 1735. That's it. So for the time being, given that the downward motion seems to have been interrupted and the precious metals price stabilized just above the 1830 support line, we tend to maintain a bias for the sideways motion to continue. The RSI indicator, though, is still at pretty low levels. It's just above the reading of 30, which may imply a residue of bearish sentiment within the market for the precious metal, in which case, should the bears take over, we may see the price action dropping, breaking the 1830 support line, and start aiming actively for the 1785. On the other hand, should the bulls take over, I would expect the price action to rise, possibly breach the 1880. Let's have a look at US stock markets. We make a start with the Dow Jones. Let's readjust the labels. Now we see that there is a sideways motion between the 34,400 and the 33,460. There are some slight bullish tendencies, but it's very, very slight. Note how this peaks are rising slightly. There's a testing of the 34,400. Nothing conclusive. The RSI indicator is at 54.6, also nothing conclusive. And note how the Bollinger Bands are narrowing, implying low volatility. All of that tends to imply that most probably the sideways motion between the R1 34,400 and the S1 33,460 is expected to continue. Should the bulls take over, I would expect the price action to rise, break the R1 34,400 and start aiming for the R2 35,500. Should the bears be in charge, we may see the price action dropping, breaking the 33,460, and that would open the way for the 32,500. Let's have a look at Nasdaq. Nasdaq, which was on the rise yet failed to reach the 12,825. I would expect the sideways motion to be maintained between the R1 and the S1, but the first element which we should note is that there seems to be an upward movement supported by an upward trend line, and it's this one. It's a pretty clean, lean upward trend line. I would also note how the 200 and the 100 moving averages are pointing upwards. Allow me to change that. And convert them to the 50 and the 100. Again, moving upwards, as does the 21. Note how the price action practically corrected low after hitting the upper Bollinger Band. The RSI indicator reached the reading of 70 almost and is correcting lower. It's currently at 62, but it's still pretty high. So the bulls are still around. I would expect the upward movement to continue, albeit a correction lower could be in the cards for Nasdaq. But overall, there seems to be an upward movement, and as long as the upward trend line remains intact, we maintain our bullish outlook. Should the bullish outlook be actualized, we may see the price action reversing direction, breaking the 12,825. And that would be another confirmation of the bullish outlook, as that would practically imply a higher peak than this one, and start thus aiming for the 13,145. On the other hand, should the bears take over, we may see the price action dropping, breaking the upward trend line. That would be the first signal of a changing trend. And for a bearish trend, I would require also a breaking of the 12,450 support line, a level which provides support here and here. Should the S1 be broken, the next possible target for the bears would be the 12,220. It's pretty close, and we wouldn't be surprised to see it being broken as well. For the time being, though, upward movement is being maintained. Let's have a look also at WTI prices. Now we have a number of elements which tend to imply that the sideways motion is set to continue. One could argue that the sideways motion, the range-bound motion, may be narrower than the distance covered between the S1 and the R1. Boyset Research had mentioned the possibility of a mid-level, which should be placed somewhere here. That would be the 80.72. Nevertheless, should the sideways motion be maintained, or at least that's what's being suggested by data. Say, for example, we have the narrowing of the Bollinger Band, which implies low volatility. Note how the RSI indicator is revolving around the reading of 50. implying also a sideways market movement, as it implies also a rather indecisive market. Note how the 50, 100, sorry, give me a sec. Yeah, the 50, 100 and the 20 moving averages are pretty close, have flattened out. All of that tends to imply sideways motion. And yes, I wouldn't be surprised to see the price action being confined between the 80.70 resistance line and the 78 support line. Should the bears take over, I would expect the price action to drop, provide us with a clear breaking of the S178 support line, and start aiming for 73.60. On the flip side, should the bulls take over, I wouldn't be surprised to see the price action rising, breaking the mid-level. I would require though also a breaking of the 82.65 resistance line before the bulls actually set eyes on the 89 resistance level. Before we move on though, we have to note here that EIA reported a massive increase in oil inventories of around 16 million barrels. And allow me to have a look at the market reaction at the moment of the release, drilling out to the 1 minute chart, widening it, unlocking it, and let's go back. Readjusting, allowing 6:30. The release was about this time. This is the market reaction, and you can see it more clearly here. See how the price dropped, and it dropped practically from $78.55 to hitting the support line of 78, so it was a drop of around $0.50 per barrel. But the market quickly recovered, had some more bearish reaction later on, yet within 3 hours it was back on the levels it was before and even rising higher. So the release as such had an initial market reaction, but the reaction as such didn't last long. Okay, that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Today, we will look at debt-based investments and their difference from stocks. While as a trader, you can trade stocks via CFDs without actually owning the underlying instrument, an investor will invest in the actual stock and own it. Most investors focus on investments that aim to increase wealth and to help them reach their financial goals like a comfortable retirement or the ability to pay for their children's education. When investors buy stocks, they purchase assets whose value is expected to increase and provide a nice return when sold. Investing in stocks also allows the owner to access a portion of the company's profits through dividends, share buybacks, or reinvestment, which helps to grow the company's and the stock's value. The stock market offers volatile returns over short periods of time, such as 5 years or less, but high returns over decades-long time periods. Debt investment can be government, corporate, and municipal bonds, as well as real estate investments, peer-to-peer lending, and personal loans such as mortgages. With a debt-based investment, you do not own an asset or a company, but instead you lend money to an individual, corporation, or government in exchange for a fixed income in return. Such investments typically offer a lower return than stocks, but are considered to be more consistent. There is some risk involved, as you might not be able to receive the funds you have loaned, and it's so important to choose your investments wisely. While they might be less risky and volatile than equity investments, they offer lower returns. The bond and mortgage market has fewer price changes than stocks. Equity investments, such as stocks, are securities that allow investors to have a claim on the earnings and assets of the corporation. Common stock trader on popular stock exchanges is the most popular equity investment. The stock market is very volatile, with rapid changes in share values. These fluctuations are usually related to political, social, or other issues in the home country of the corporation. Equity investments are famous for high risks and potentially higher rewards. It is traditionally recommended to investors that they hold both equities and debt-based investment for better diversification of their portfolio. Debt-based investments perform differently than stocks and increase during years of large stock declines. An individual's exact allocation is dependent on the investor goals, risk preferences, and investment time horizon. When it comes to trading, it is important to understand that all trading comes with risk. Depending on your trading goals, you can choose what suits you the best. You can always tailor your trading actions to match your objectives and risk tolerance. Thank you for watching.
Okay, just a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Okay. So this material is just a personal opinion of the authors and the client's investments objectives, and risk tolerance have not been considered. Okay. IronFX is not responsible for any loss arising from any information contained. So redistribution of the material is strictly prohibited. Okay, I think I might have a setting that I need to change. Okay, wait. Okay, give me a moment. Setting up. Okay, let me continue. Kindly increase your volume. Yes, please increase the volume. I think I'm speaking at the max, as loudest as I can already. So let us begin. So I'm actually from Everest Fortune Group, and my name is Chen Yongjing, and I'm the trade analyst for the company. We are the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a special collaboration with IronFX, where we are bringing you guys the good stuff. So IronFX right now, you can actually go to ironfx.com. For those who do not know, you can go to the website. If I'm not wrong, IronFX School, under webinars, listed as popular. You can see the, let it load first. Okay, you can see the, okay, I'm not sure why my face is not up here yet. All right, it's okay. So you can actually see the upcoming webinars. Wait, let me find the, okay, over here. We have the timetable for the upcoming webinars that you guys can actually attend. So right now is this webinar is live. So feel free to check this link out. So by the way, I know some of you guys want to contact me outside of this webinar. So feel free to check out my link tree. So this is actually a quick guide about myself. You can actually check out my Instagram, my YouTube, my LinkedIn profile. Feel free to follow me. All right, let us begin. So today will be a shared webinar. It will be with myself, Yongqing, and Sarah. So at the second half of this webinar, Sarah will be taking over. Okay, let us continue. So a few topics to cover today. So we'll be covering on, let me pull this chat around. We'll be covering on basics of news trading, key news events to watch out for, how each news event affects the markets, and 3 types of news trading strategy. So today will be a very, very dry lesson. So be prepared, get your coffee. I won't be showing much technicals. Today is all about the news, all about fundamentals. It might be boring, but it will help you a lot in a basic understanding of how news events actually affect the market, how you can bank on it to, scalp or either take a long position. So coming up first, 4 main factors to consider. Firstly, it's crucial. Okay, you can see a few points here, news events to pay attention to, what news events you want to pay attention to, and the expected data. So you want to also check the price reaction from previous news release. So firstly, it's very crucial to keep track of news events. I'm reading these points. And expected data releases. Economic indicators such as GDP, let me write this down, GDP, unemployment rates, inflation, can significantly impact currency values. Therefore, keeping an eye on the economic calendar and being aware of upcoming news releases can give traders like you guys an edge in predicting the market movements. So secondly, the price reaction from previous news releases is also an essential factor to consider. Traders can analyze how the market reacted to previous data releases and use this information to make educated guesses about how the markets will respond to future releases. So doing so, what you can do is you can go to Forex Factory. Let me show it to you. You can head on to Forex Factory. I'll send the link to the chat, so it's under calendar. Feel free to check out this link. Forex Factory, head on to Forex Factory. You start to look at all the news events. For example, tonight we have the United States dollar, core retail sales month-on-month, Empire State Manufacturing Index, retail sales month-on-month. So you do not know what does it do, how does it affect the markets. So what you can do, you can read a quick summary, click on it, read how it usually affects, what you can have a summary change in total value of sales at the retail level, excluding automobiles. Can read more details about it. Go back to the forecast. So I think the more important one is core retail sales. So you can go back to the previous data release, which is on September 15, 2022. Go to your chart, click on it, start to go back and see how the news event actually impacted the United States dollar. So go head on to your DXY chart. Negative 0.3% versus previous 0%. So September 15, we can take a look at it. Let me load out my layout. Okay, so we'll be going through on core retail sales month-on-month on the DXY chart. Okay, DXY. So let's go back on the daily chart. September 15. September 15, right here. So notice upon the news release, price actually caused price to continue moving up in the long run. So you can actually start to look at maybe the 4 hours or 1 hour chart, want to see what happened on September 15. So September 15 around at night, price actually shot up before heading back down. You can start to check a reaction, what it does. Hits up first, clears the previous high. So every different news release is very, very different from each other. So find out the characteristics. First, it went up, cleared the previous high, went back down, tapped into some kind of support. So you back test it and back test this. I'm just giving you a very, very basic example. So you start to move on. I wouldn't be showing everything. So you'll be moving on to October 14, 16, December 15, January 18. Start to look at all this data, how it affected, how price moved, get into account. Please do not just jump right in and try to trade the news event tonight just because you did some quick back tests on core retail sales and Empire State Manufacturing Index. So moving on, back to the charts. Okay, back to the PowerPoint. So current trend, why is it very important? Okay, current trends in the markets are another crucial aspect of Forex trading. Traders can use technical analysis tools to identify trends, such as moving averages or trend lines. It's essential to know whether the market is trending upwards, downwards, or sideways, as this will influence trading decisions and risk management strategies. So last but not least, support and resistance levels is still very, very important in Forex trading. Important to consider. So these levels actually represent price points at which the market has historically shown support or resistance. Traders can use this information to determine where to set stop loss. So you can use it as a gauge stop loss and where to put your take profit level. Okay, moving on next towards the news events and expected data. So we actually have a very nice, clear screenshot of Forex Factory. So as Forex traders, it's very essential. Okay, before I continue, so we are actually focusing on the AUD. So right here, this specific news event is what we are focusing on. So as Forex traders, it's very essential to place close attention to the economic calendar and be aware of any upcoming news events and expected data releases. Firstly, these events can cause significant market volatility, which can lead to increased trading opportunities. For example, if a news event indicates that a country's economy is improving, traders might buy that country's currency, expecting it to strengthen. So as a result, the value of that currency might increase, creating a trading opportunity. Okay, secondly, moving on to the expected data part. News events and expected data releases can provide valuable insights into the health of an economy. So these indicators can help traders understand how a country's economy is performing and whether it is growing or contracting. Traders can use this information to make informed trading decisions, such as deciding whether to buy or sell a particular currency. So third points that we want to go through. News events and expected data release can influence central bank decisions on interest rates. So we have the Bank of England, the Reserve Bank of Australia, etc. So can influence central bank decisions on interest rates, which in turn can affect currency values. So central banks actually use interest rates to control inflation and stimulate or slow down economic growth. So if a central bank announces a change in interest rates, it can impact the currency value and create trading opportunities. So last but not least, news. So just to summarize overall what I've just talked about this entire slide. In summary, news events and expected data releases actually help traders to manage risk by providing insights into the potential impacts of specific events on currency values. So for example, if there is an expected data release that could significantly impact a currency, traders might choose to exit a trade before the release to avoid the potential volatility. So this is why I do not trade 1 hour, about 1 to 2 hours before the news release, or 1 to 2 hours after the news release. So personally, I avoid that just to prevent any mishaps in my trading accounts. I do not want my trade to potentially cause slippage, potentially hit my stop loss, just because I wanted to be greedy and try to trade the news. So we are looking at the Aussie dollar, Australian dollar right here. So we had a cash rate. So they actually increased the interest rates. So previous was 1.35%, the forecast 1.85%, and the actual was also 1.85%. So what happened? Let's take a look how the news impacted the Australian dollar. So Australian dollar chart. So every time Australian dollar had a 50 BPS hike on the 7th June, price went down. 5th July, 50 BPS hike, price went down. 2nd August, BPS hike, price went down. 6th September, 50 BPS hike, price went down before going back up and continued going down. So we already know we have a data set, we have proven data on the charts. Data do not lie. So every time we have a news release like this, we can expect to possibly sell Australian dollar, AUD, USD, every time we have a cash rate news event coming up. So please screenshot this down before I continue. So I've already helped you done most of your homework, maybe for this specific news event. Please screenshot this down before we continue. Okay, moving on next. So I'm just zooming in on the 5th July. I'm zooming in on this right now, on this specific day that actually happened. So I cannot remember specifically because I actually did quite a number of research. So zooming in on the 5th July, 50 BPS hike, price went up, cleared the previous high right there before it, moved down all the way down towards the previous swing low, and it actually formed a support right there. So you already know price goes up first before heading down. So please screenshot this down before we continue. This is still related to the previous slide that I just showed you guys. Okay, next. The 2nd August 50 BPS hike. You notice that price also went up first respectively right there on a smaller time frame. It then, after the news release, immediately went down towards the previous support level. So every time we can expect price to likely head up first before the news release, before potentially just continue heading down towards the next key support level. Okay, moving on next to the key news events to watch out for. So we actually this is quite a long slide that I have to go through. So there's a theme of economic focus on what happened in the past, how it affected the markets, all the fundamental drivers that affected. first of all, going through the global financial crisis. It happened during the 2008 to 2009. Then the economic focus was a lot on employment data and wage growth. So for those who do not know, the global financial crisis is also known as the Great Recession. So it had far-reaching consequences for economies and individuals worldwide. It was triggered by a combination of factors, including subprime mortgage lending, a housing market bubble, and excessive risk-taking by financial institutions. So the crisis actually resulted in widespread job losses and had a severe impact on the employment market. So the unemployment rate in the United States, for example, it rose from 5% in 2007 to a peak of 10% in 2009. So many companies struggled to stay afloat, and as a result, many workers lost their jobs. Additionally, the crisis had a knock-on effect on other economies, leading to job losses worldwide. The crisis also had a significant impact on wage growth. As unemployment rates rose, employers had less incentive to offer pay rises or bonuses, and some even cut wages. So in the US, wage growth slowed from 4.4% in 2006 to 1.8% in 2009. So let me draw it. 4.4% in 2006 to 1.8% in 2009. So it made it difficult for many individuals and families to make ends meet. Okay, let me write this down. Unemployment data, 5%. 2007, it moved to a peak of 10% in 2009. So the global financial crisis had a domino effect on the world's financial markets as the interconnectedness of the global financial system became evident. Financial institutions that had invested heavily in mortgage-backed securities and other high-risk assets faced significant losses. And many banks and other financial institutions went bankrupt or required government bailouts. The crisis also prompted significant government intervention. Central banks around the world cut interest rates, and governments introduced stimulus packages to try to prop up their economies. However, it actually took several years for the global economy to recover fully from the crisis, and many countries are still feeling its effects. So overall, the global financial crisis was a watershed moment in the world economy, with far-reaching consequences for individuals and economies worldwide. The crisis had a very severe impact on employment and wage growth, leading to a significant job losses and slower wage growth. So the financial markets and central banks all had to take unprecedented measures to address the crisis, and its effects are still being felt today. Next, we have the COVID pandemic. I guess we just got out of it. So now it's the post-COVID. So COVID happened 2020 to 2021. All of us went through it. The pandemic had far-reaching consequences for individuals, economies, and societies worldwide, and its effects will be felt for years to come. So one of the most significant impacts of the COVID-19 pandemic was on the gross domestic product, the GDP. So which is actually a measure of a country's economic activity. The pandemic led to a massive decline in economic activity as many businesses were forced to close or operate at reduced capacity due to lockdowns and restrictions. So the International Monetary Fund, the IMF, estimated that the global economy contracted by 3.3% in 2020, the most significant downturn since the Great Depression. So the pandemic also had a significant impact on employment. Many people actually lost their jobs due to business closures or reduced hours. The unemployment rates increased in many countries, and the number of people working part-time or on a reduced pay also rose. So as a result, many individuals and families experienced financial hardship, making it difficult for them to meet ends meet. The pandemic had very significant consequences for healthcare systems, with hospitals, healthcare workers overwhelmed by the sheer number of COVID-19 cases. Governments around the world had to invest heavily in healthcare infrastructure, including building new hospitals and acquiring medical equipment, such as ventilators and personal protective equipment, PPE. So moreover, the pandemic had a profound impact on global supply chains, with disruptions affecting industries such as manufacturing, agriculture, and logistics. Travel restrictions and border closures also led to a decline in global trade, affecting economies worldwide. So overall, governments and central banks around the world responded to the pandemic by implementing fiscal and monetary policies to support their economies. Many countries introduced economic stimulus packages, and central banks lowered interest rates to encourage borrowing and spending. So right now we have the 2023 recession that is coming up. So we'll be focusing on inflation data and interest rates. So this recession was triggered by several factors, including inflation, rising interest rates, and the COVID-19 pandemic. So inflation was one of the most significant factors contributing to the recession. So in many countries, inflation rates reached historic highs due to supply chain disruptions, labor shortages, and rising commodity prices. Commodity is wheat, corn, rice. So high inflation led to increased costs for businesses and consumers, causing a decline in purchasing power and economic activity. Interest rates were also a contributing factor to the recession. Central banks have raised interest rates in response to the rising inflation, which made borrowing more expensive for businesses and individuals. So higher interest rates also led to a decline in consumer and business spending, reducing economic activity. Okay. Give me a moment, let me get a cup of water. Okay, the COVID-19 pandemic also had an impact on the recession. The emergence of new COVID-19 variants and the resulting restrictions led to reduced economic activity and job losses. Many businesses, particularly in the hospitality and tourism industries, were forced to close or operate at reduced capacity, resulting in a decline in economic output. So the recession is leading to a significant increase in unemployment rates in many countries, and many individuals and families experience financial hardship. So governments are responding to the recession by introducing stimulus packages and implementing monetary policies to support their economies. Central banks around the world lowered interest rates and introduced quantitative easing measures to support the economy. Governments also introduced fiscal stimulus packages to support businesses and individuals. So these policies actually help to stimulate economic activity and support job growth. So this is just for general information about what has happened in the past 15 years or so. Okay, let me see what's next. Okay, non-farm and employment change. So this is a very, very important thing. It actually occurs on the first Friday of the month. Okay, one of the most closely watched, okay, just these 3 points, screenshot it down. It's related to the change in number of employed people during the previous month, job excluding the farming industry. So this is only for the United States only. Only US, it's not anywhere else in the world. So job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So it's also a high price volatility event. So NFP, also known as non-farm payroll, is a key indicator of the health of the US economy and is closely monitored by traders, investors, and policy makers. So NFP measures the number of new jobs created in the United States, excluding the agricultural sector. The report is released by the US Bureau of Labor Statistics on the first Friday of every month and provides insights into the strength of the US labor market. So the NFP report provides 2 pieces of information: the number of new jobs created in the previous month and the unemployment rates. The number of new jobs created is a crucial indicator of economic activity, as job growth typically leads to increased consumer spending and overall economic growth. The unemployment rates, on the other hand, provides a measure of the health of the labor markets and can influence central bank policy on interest rates. So the NFP report is considered a leading indicator of economic growth and is closely monitored by traders and investors. A better than expected NFP report typically leads to a rise in the US dollar's value, as investors anticipate increased economic growth and the possibility of higher interest rates. So a worse than expected NFP report, on the other hand, can lead to a decline in the US dollar's value. So as investors become less optimistic about economic growth and the possibility of interest rate increases. The NFP is also closely monitored by policymakers, including the Federal Reserve. The Fed uses the NFP report to determine whether to raise or lower interest rates. So with higher employment rates, it actually leads to higher interest rates. Okay, please screenshot this down before we continue. Okay, next. Moving on towards interest rate decisions. So central banks hike interest rates to increase the cost of borrowing. It slows down economic activity. These are the main important points only. Please screenshot it down. It reduces or slows down the speed of inflation, and it's also a high price volatility event. So interest rates are a crucial tool that central banks use to manage inflation, economic growth, and financial stability. Interest rate decisions can have a significant impact on currency exchange rates, stock and bond markets, and individual financial planning. So interest rate decisions are made by central banks, which are tasked with maintaining price stability and supporting economic growth. Central banks can adjust interest rates up or down depending on economic conditions and their policy objectives. A rise in interest rates can reduce consumer spending, lower inflation, and support a currency's value. A cut in interest rates can stimulate borrowing and spending, support economic growth, and weaken a currency's value. So interest rates are typically announced after a meeting of the central bank's monetary policy committee. The announcement includes a statement that outlines the central bank's reasoning behind the decision and any future policy changes. The statement can provide insights into the central bank's outlook on the economy, which can influence financial market expectations and individual investment decisions. So it can have a significant impact on financial markets. A rise in interest rates can lead to a decline in the stock markets as companies' borrowing costs increase and consumers may reduce their spending. So higher interest rates can also lead to a strengthening of the domestic currency, making exports less competitive. A cut in interest rates, on the other hand, can lead to a rise in the stock markets as companies' borrowing costs decrease and consumers may increase their spending. Lower interest rates can also lead to a weakening of the domestic currency, making exports more competitive. Okay, let's move on. So the inflation data, the CPI. So the consumer price index, so it actually measures the change in price level, indicates the change in the cost of living, and the target CPI for the economy is 2 to 3%. So please note this down. This is very, very important. Please screenshot this down. So the CPI measures the average change in prices paid by consumers for a basket of goods and services over time. So it's a crucial indicator of the health of an economy and is closely monitored by policymakers, investors, and consumers. So inflation is the rate at which the prices of goods and services increase over time. A high rate of inflation can lead to a reduction in the purchasing power of money, making it more expensive to buy goods and services. On the other hand, low inflation can lead to deflation, which can harm economic growth and create disincentives for businesses to invest. So the CPI is used to measure inflation and is one of the most commonly used indices. The CPI calculates the average price of goods and services, including housing, energy, healthcare, and transportation. Mind my writing. It's a bit hard to write using the pen. So changes in the CPI can over time provide insight into the rate of inflation. So the CPI is released on a monthly basis, closely monitored by policymakers and investors, provides insights in the state of the economy, and can influence monetary policy decisions. Okay, so high inflation leads to a rise in interest rates, which can increase the cost of borrowing and slow down economic growth. Low inflation can lead to a lower interest rate, which can make borrowing more affordable and stimulate economic growth. So inflation data also has an impact on individual consumers. A high rate of inflation can lead to increased costs for everyday goods and services, which can reduce consumers' purchasing power. Low inflation can lead to lower costs for consumers, making it more affordable to buy goods and services. Okay, let's move on. Right now, Sarah will be taking over. So yeah, let's welcome Sarah. I'll be taking my leave.
Hi everyone, my name is Sarah. Okay, so today I'm going to take at the second section of this webinar. So just now Yunjin has mentioned it. Okay, so for the Kiwi dollar, the CPI news is really important. So now let's take a look at the next slides. It's about how the give me a moment. let's take a look at this slide is how the news is affecting our price and how the price is reacting towards the news. Okay, you can see before the news come. Sorry, where is my mouse? Okay, here. Can you see my mouse? Okay, so you can see before the news come, there is a very nice steadily ascending trend line. So the price is going to react it according to the trend line. Okay, and you can see before the news come, the price is more in a consolidation, means the price isn't moving very much. Okay, so it's more like up and down, but in a more horizontal way. But you see at the 6 p.m., the news have come out. Okay, so the news will affect the price of the market. That's why the price has shooted up. Okay, shoot it until where? Shoot it until the period swing high. So always take note when we are reacting towards the news, always looking for a reference point. Don't always say that, oh, the price may go up to here or the price may go up to here. Okay, you need to find a reference point, which is very important. Most likely the reference point is the period swing high or the period swing low. Depends on how you judge the news going to affect the market. Okay, next one. Okay, so you can see here are all the news. Here are all the news of the. Here are all the news of. It's very important news on the 13th October. So always. Okay, so always remember the news event. You need to pay attention, and the expected data. Always pay attention on the current trend, okay? And always pay attention on support and resistance lines. So their price is going to reaction after from the previous news release, okay? So you need to take it as a reference. Okay, so here you can see there is a news coming up. I think it's at before the price is consolidation. So you can see the price didn't move a lot. After the news release, the price has shooted up and now retreats back. So how each news event affects the market? So for short-term effect, okay, so there are some news will affect it in a more short-term term. So for example, employment change, retail sales, and purchasing manager index. So later at 9:30 p.m., there are retail sales for USD. So maybe later we can pay attention to it and we see how the news is going to affect the market price. So employee change is a very key indicator of economic health and have short-term effect on our trading. A strong employment change report can indicate a growing economy and increase customer confidence, leading to a stronger currency. In another scenario, okay, a weaker employee change report can indicate a weaker economy, leading to a weaker currency. So most likely the employment change is correlated to the currency. So if employment change is good, okay, so the currency is going up. If otherwise, it will go down. So how about for retail sales? Retail sales are another economy indicator, indicate that short-term impact on the trading. So retail sales measure the total amount of goods and services sold by retailer. And a strong retail sales report can indicate increased customer confidence and spending. This can lead a stronger currency as the investor become more optimistic about the economy. A weaker retail sale report, on the other hand, can lead to a weaker currency, as the investor become less optimistic about the currency. So this one same as employment change. Okay, retail sales good, currency go up. Retail sales bad, currency go down. So lastly, the PMI. Okay, so PMI is a survey of purchasing manager in manufacturing sector that measure the level of business activity. The PMI can have a short-term effect on forex trading. It provide the insight into the strength of the manufacturing sector and the overall economy. A high PMI indicated increased manufacturer activity and growing economy, leading to a stronger currency. So in alternate scenario, a low PMI will indicate a weaker economy, leading to a weaker currency. So all three of these are very correlated to the whether the strong or weak is the currency. So the better the number is, the better the currency. The weaker the bad the number is, the weaker the currency is. So bear in mind, so this three factor is only going to affect the currency in a short term, which means after the most likely after the news has been released, within like a few hours, or like within a short term, the price will be changed according to the news, but it's unlikely to going to affect the currency in long term. So now let's take a look at what will affect the currency in a medium to long term. What are the factors? So first one, very straightforward, is GDP. And another one, secondly, is the CIP. And lastly, the interest rate decision. So let's take a look at GDP, okay? GDP is a measure of country economic output and is considered one of the most important economic factor. GDP measures the total value of goods and services provided within a country border and provided insight into overall health of the economy. A high GDP can indicate a growing economy, which means a stronger currency. A low GDP indicates a weaker GDP and lead to a weaker currency. So imagine the news has released like United States, the GDP has went up, which means the price of the currency will go up. So secondly, let's talking about inflation data. Inflation data as measured by Customer Price Index, CPI. So it's another key economic indicator that can impact forex trading over medium to long term. A high rate of inflation can reduce the purchasing power of the currency, leading to a weaker currency. In other hand, low inflation can lead to stronger currency, which indicates a stable and growing economy. So lastly, our interest rate decision. Interest rate decision are also important indicator for our trading. So central bank use interest rate to manage inflation and support economic growth. A rise in interest rate can lead to a stronger currency, as the investor may be attracted to a high interest rate. Most they want to deposit in that interest rate, or because it's high interest rate, I can deposit over and to gain more interest. So in alternate scenario, in alternate scenario, a low interest rate means less demand of the money, which means the currency may be dropped. So this three factor, or this three related news about this three factor, is going to affect our currency in a more medium to long-term effect. So imagine like this kind of news has been released, okay? Maybe the price may not move like a lot, but in the future or in a more mid to long term, the price is going to react to these factors. Now let's take a look at news trading strategy. Means how are we going to enter in a trade by the news or like according to the news? So there are three different kind of trading strategy. Firstly, entering before the trade release. So most likely we are looking at 1 hour or 15-minute chart. So what meaning by entering before before the release means we are predict on the numbers. Imagine like later the retail or the US retail news going to release. Okay, so let's just make a prediction whether the news is good or not than compared to the previous one. Okay, so if you are considering, okay, I have confidence in this, okay, the news is going to be good, means better than before. So this you may enter in the trade in a long position, which means I think, okay, USD will go up. So the goal is to catch the maximum move following the news release. Because you are entering the trade, most likely you are putting a buy or sell limit before the news release. So the strategy can be very dangerous, as the trader can take advantage of significant price movement. However, there is a risk of being backed off, as the market can react unpredictable to the news release, which means maybe the news may be good, okay, but the market did not respond in after the news come. So maybe the news good, but the price still dropping down. So maybe it will hit your stop loss. Then finally, the market has reacted to the news. There may be a chance in this kind of scenario. So how about our second strategy? Our second strategy is using pending order. This involves placing an order ahead of news release. Okay, so it's more likely using a 1 hour chart. The strategy has less emotional involvement. Okay, so as the traders set their orders and wait to the market to fill them. However, there is a risk of price spillage, as the market can move significantly after the news release, causing the order to be filled at a different price than expected. So our third strategy is to reacting to the news release. So means after the news release, we are reacting, we entering the trade according to the news. Most likely, we are using 15-minute or 1-minute chart. So this involves the trading you used it on 15-minute and 1-minute chart. Trader wait for the news to release or to come out. Then they react based on the price movement. This strategy can be beneficial, as the trader can react to what they are seeing in the market. However, there is a risk of being influenced by price movement and making irrational trading decisions. So each strategy has its own set of good advantage and disadvantage. So when we are entering the trade, think carefully to see which one is best fit your trading strategy. And also always remember, manage your risk. Trader must be prepared to accept the loss and have a solid risk management strategy in place before you enter in any trade. Okay, so that's all of today's webinar. Is there any more questions? So by the way, later at 9:30 p.m., there is a very important news on USD. So maybe you guys can pay attention on it. How would you feel the USD going to react? Okay, so if no more questions, I may just end today's webinar. Thank you, Adrika Das. Thank you, Iram Atadi. Thank you, Mogizi Likope. And thank you, Steve Code. Okay, forgive me if I pronounce your name wrongly, but really thank you for you guys attending this webinar. Okay, that's all of today's webinar. Thank you. Bye.